Welcome back to this second session of investing. We started in the first session and we talked about investing from a very basic, from an introduction point of view. In this session, I'm going to spend some time sharing what I call a second layer to where I stopped in the previous session. But just before I move forward, perhaps it's best to probably summarize where we got to in the last session. I began the session by explaining the principles of investing, primarily by looking at the first decisions that you have to take into account if you want to become an investor. And part of that decision was I used an analogy. I used the concept of a journey. I said that every journey has three important parts to it. The first is you have to understand and be aware of where you are, the present location. Secondly, you have to be aware of where you want to get to, which is your destination. And once you have both your destination and your location ascertained, then it's easy to identify the best roadmap, the best route to get you from A to B. And interestingly, if you progress from wherever you are to where you want to get to, that journey is called success. L. Nightingale said that success is the progressive realization of a worthy goal or worthy ideal. In other words, if you know where you are and if you know where you're trying to get to and you're moving progressively towards the attainment of that goal, then that's success. In the previous session, we started by looking at the most important part of that three-sided coin or equation. We said the first thing you have to understand about investing is you've got to begin by defining what you really want, the vision, where you're trying to get to. Then I said you have to also come back and ask yourself a series of questions such as, where am I right now financially? How deep is this pit that I'm in, or how high is this mountain that I'm in? If you know where you are, then you can then design the best way to get to your destination. But to try and attempt to get to the destination without really being aware of your present situation financially, I think is slightly misleading. Anyway, that was what we talked about yesterday. That was a summary of what we talked about yesterday. And I said that that's critical because in many parts, what you're doing by going through those simple questions is you're laying the right foundation. In today's session, I'm going to put another layer on the foundation we've already constructed. Today's session will be quite similar to the previous. It'll be simple. I'm not going to use any boards. I'm not going to use any paper to do calculations. That's all secondary. Let's just deal with the basics. Keep it very simple. Now, let's assume that you already have the first part covered. And by that, what I mean is you have your destination, you have an idea about what you want, you have some knowledge about where you are right now in terms of your location. The question you might be asking is, okay, how do I begin the journey? Well, let me start with a question that you might want to consider. Now, the question that I might start with is the question that goes like this. Why do you want what you want? Why do you want what you want? You have to always begin with reasons in everything in life. You must start with the question why. Because if you know the why for anything in life, you can achieve the how. The how to is always of secondary importance. The what to do is of secondary importance. The true question you should always focus on is, why do I want this? The reason is because if you understand the why, it keeps you focused, it gives you passion, it gives you inspiration, it gives you motivation, and more than anything, because the success journey and the investment process sometimes is a lifetime journey, you have to be strong. You need something that you can hold on to, like a magnificent obsession, something that keeps you focused. Now that why could be because you want to provide for your family. That's a great why. That why could also be because you want to buy maybe a home for your mom, or maybe you want to be able to give your loved ones an experience that they will never forget. So we do things, everything we do for a reason. Sometimes we don't know what that reason is. But if you can understand what that reason is and bring that reason into your planning process, and if you have a lot of reasons, you find that it's so easy for you to stay focused. Because I can promise you something. If you're going to be an investor, whether you're going to do it part-time or whether you're going to do it full-time, you have to have what I call the patience of Job. And what that means is that you're going to go through cycles. And those cycles will not always be pleasant. Sometimes you have what we call an up cycle, which is what we call a bull run, or you might have a down cycle, which is what most people call a bear run. So if you understand economics, you know that the economy goes through cycles, short cycles, long cycles, and you have to be prepared for what could happen in between cycles. And so you need the patience of Job. Anyway, let's start today's session with the next step in that process. One of the things you have to start off with is understand what investing is. The definition of investing is somewhat subjective. Everyone has their own definition, but I'll share one that I think is quite interesting, and I'll let you decide for yourself what investing is to you. One of the ways you must always either review your decisions is to always try and make it objective. Now, there are many things in life that cannot be measured objectively, but when it comes to finances or economics, it's easy to measure it objectively. So the definition of investing that I use is that investing is simply the process of using capital or using money. Capital and money are both the same thing. Using money or capital and putting it out intelligently in such a way that you expect to get your original capital back and get some more back. So with investing, you're saying, I'm going to put money out to get it back in return and get something more. That's a very layman's definition of investing. Anyone can understand that. But for that definition to be complete, or for your investment process to be complete, you have to answer 3 questions. The first question is there going to be preservation on my capital? Is my original seed, the seed that you have, that you're going to invest, is there going to be protection on that capital? That's the first question. The reason it's important is because the first rule of investing is don't lose money. And the second rule of investing is don't forget the first rule. Now, those were from Warren Buffett, who many of you already know, and he's considered to be the greatest investor of our time. He said the first rule of investing is don't lose. The second rule is don't forget rule number 1. So the first question you're asking yourself when you want to invest, and if you're trying to engage in an opportunity that requires your capital, is there protection? Is there preservation on my capital? The second question you want to ask is, what will be the return on my investment? What will be the return? Now that word, depending on the investment asset class you choose, is used in different ways. If it's in property investing or real estate, some people say yield. What is my yield? What is the return on invested capital? If it's within stocks, some people might say, what is the dividend that I'm going to get back? The dividend yield, or interest. Probably a simple way of putting it, interest. What is the interest I'm going to get back? Because the level of interest you get back should dictate whether you engage in the activity or not. And the third question you want to ask yourself is this: is the possibility of loss present, and can I influence that possibility of loss by reducing it? Can I reduce the risk of loss? And can I maximize the certainty of gain? Very simple. Can I influence? Am I in control? Do I have any control whereby I can influence and reduce the probability of loss and maximize or increase the certainty of gain on both me getting back my investment capital and me also getting back my interest or my yield or my return on investment. Now, to the extent that you have those three questions answered in the affirmative, we say that you have just engaged or you're about to engage in an investment process. Whenever the answer is no, we say you're speculating. And there's a thin line between investing and speculating. I usually call it the razor's edge. It's very difficult sometimes to know whether you're speculating or investing. But if you ask yourself these three questions, you would know. In many ways, with speculation, you have no control. In other words, the possibility of gain is low. The certainty that you're going to get your original capital back and you will get your interest back is low. The possibility of loss is high. That's speculation. In many ways, you're doing what we call greater fool investing. You're investing based on hope. You're investing based on opinions. You're investing based on trends and possibly emotions, how you feel. But with investing, it's the opposite. The probability of gain is high. The possibility of loss is low and can be reduced. With investing, you're investing using facts. You're not using opinions. You've taken all the guesswork out. You're doing what we call fundamental analysis. So investing is simply the process of putting capital out into an opportunity in such a way that you get more as interest back, but also you get your original capital. That is an investment process. Now, with that definition, I'm going to take you to the next step of this process. You understand what investing is. The question is, okay, what do I do next? Well, there are various, what I call styles that you have to choose. You first have to decide whether you're going to be a speculator or whether you're going to be an investor. Now, it's important you understand that there's nothing wrong with speculation as long as you know that you're speculating. As long as you're aware that what you're engaging in is speculative. There's nothing wrong with that. But the problem comes in when you call a speculative opportunity an investment. You can't mix the two. So choose for yourself what and who you want to become, and who you want to be. There have been so many people who have become very wealthy through speculation. George Soros, one of the wealthiest men, and he is what you call a speculator. He's called an investor, but the type of investment he engages in is more speculation. He deals with more macro factors, and it's all about changes in conditions. But there are, in many ways, if you go through his investment philosophy and process, you can see that he's not following the very basic approach to investing. On the other hand, on the other side of the equation, you have someone like Warren Buffett, who is still the third wealthiest person in the world today. And he is what you call an investor because he follows traditional processes towards investing. Now, none of the two, I'm not going to suggest that, you must follow one pathway. What I'm going to try and teach you, however, is the investment process. What is interesting is that you can use the investment process in a speculative environment to help you protect your investment return, but also to protect your capital. So for me, I tend to focus more on using the philosophy of investing, and you can use it in any walk of life or in any area of business that you might want. So the first part, once you've gone through understanding what investing is you have to go through a process of saying, okay, what do I want to be? Now, let me give you a good example so you can see how this works. You can choose to be what we call a growth investor. You can choose to be what we call a momentum investor. You can choose to be what we will call a traditional speculator. Or you can choose to be what I call, and what I believe in, and what I think everyone should understand is the principle we call value investing. Value investing. Now, in many ways, The first three that I defined, growth, momentum, and speculation, fall within the same category of speculation. You can put all of them within speculation because in many ways, if you're a growth investor, for example, you would be what we will call a venture capitalist or an angel investor. That simply means you identify an opportunity that is still at the stage of it still being maybe an idea. There's nothing that has been created. There's no history for you to do your analysis and identify the risks. So what you're doing is you're making an investment based on what you believe this particular opportunity will grow to become. So it's high risk, high reward. There's nothing wrong with that. If you're a momentum investor on the other hand, you could be the kind of person who has identified a company, identified an opportunity, identified an environment, and you've noticed that the trend is growing. For example, it could be that corn, the value and the price of corn has just started to go up. And so you get into investing in corn, which is a commodity, because you believe that you can stay with the trend and you can make some money as the trend goes up. And just before the trend hits its peak, you can exit. So that's what we call momentum. You find something that is booming. It could be property. Who knows? It could be stocks. It could be a particular stock that has just announced something really important and the value starts to go up. You can jump on board. You can ride the high and then you can get out just before it starts to decline in value. That's momentum investing. And speculation is simply where you just make random guesses. Perhaps you invest in currencies, you invest in changes in particular geographical locations. Oh, well, for example, this particular political party will win and they have specific ideologies about the economy and business, and therefore you can choose to invest based on the outcome of macro factors. Those are all speculation. What I want to show you, and what I'm going to try and teach you is very simple. It's called value investing. It's very traditional. As a matter of fact, it's a principle I was taught by someone called Benjamin Graham. As a matter of fact, I would recommend, for those of you who might have an interest in investing, to look out for two books. There are two books that he wrote that I think everyone should read. The first is called The Intelligent Investor by Benjamin Graham. Probably, in my opinion, probably the best investment book ever written. The second book is a book called Security Analysis by the same author. In my opinion, again, remarkable book. If you're going to go into investing full time, you have to read both books. There's so many other books you can read, and I can spend the whole day giving you other authors. But those two books, specifically for those who are interested in value investing. Now, I've mentioned the word value a number of times so far. So let me stop and explain what value investing is. Now, what I find fascinating is that Benjamin Graham never taught a concept called value investing. He just taught about investing. It was subsequently termed value investing because of the principles that underlay the philosophy. Benjamin Graham, interestingly, was the same, is the professor, is the investor who taught Warren Buffett and who also taught Charlie Munger, who is Warren Buffett's partner. And both of them are remarkable. Interestingly, Benjamin Graham also taught a few other selected group of people. One of those people was Walter Slush, who became a very successful investor. But the principle of value investing has been adopted by so many other people since, and they've also achieved a level of success that I think is quite remarkable. But let me explain what value investing is, because if I do, I believe that you will become a little bit more open to the concepts. Value investing is what we call traditional or fundamental investing. And what it simply focuses on is simply, you want to buy assets, you want to identify opportunities that you can buy on sale. You want to buy them for a bargain. As a matter of fact, you're trying to buy them at a price that is way below what we call intrinsic value or its worth. That's really what value investing is. To keep it simple, you're trying to find things that are selling at a discount to their original price. So it's very similar to if you were to go down a shop and you were walking down a supermarket and you identify that there's a product that is selling, and normally it retails for maybe £10, and on this particular weekend, for some reason, there's a promotion and is retailing for, say, £6.25. What you've identified at that point in time is, you might say, the price, the normal market price of this commodity or product is £10. You might also identify that its intrinsic value, or that it's really worth £10, but it's selling for £6.25. That is a value opportunity, because what it means is that you're buying it at a 30% discount to its intrinsic value or to its original price. That is value investing. Now let me bring it into a more detailed explanation that might be useful. Value investing is the process of identifying assets. And identifying assets by going through a process where you have detailed analysis. So you conduct some detailed analysis, you identify the asset, you carry out what we call a detailed valuation, a thorough analysis and valuation of the assets. You identify its intrinsic value. What is it really worth? Once you've identified its intrinsic value, you apply some principles of analysis where you use qualitative and quantitative methods to see whether this particular asset, in addition to its maybe selling at a price below its intrinsic value, you identify whether it has potential for growth and desirability going forward into the future. And once you've gone through that process, you make a decision. Now here is what's very important about value investing. There are two concepts that you must always identify. Firstly, if you're going to be a value investor, you must have the ability to identify what the intrinsic value of the asset is. Secondly, once you've identified its intrinsic value, you must pay a price that is way below the intrinsic value. Now with investing, depending on the type of asset you choose, there are a lot of external factors that could influence whether you make money or you don't. Remember, with investing, all you're trying to do is make money. You're trying to get a return. Those factors that influence whether you make a return fall under so many categories. You have things such as randomness in the markets. You have errors on your part. Maybe you've done an analysis, but you forgot something really crucial or something important. There could be macro factors. In the UK, we talk about what we call the CPI, Consumer Price Index, or Retail Price Index. In many ways, both deal with a concept called inflation. For example, you've identified an opportunity, but you didn't factor in inflation. And the fact that inflation and maybe the interest rates in that particular location, like London, is about, or the UK is about to go up. So you've made analysis. You thought, for example, that you would make 5% return. Because you didn't consider inflation and other macro factors, you have maybe 3 or 3.5% wiped off from your 5% return. Now you're left with 1.5%. So what you do when you want to pay a price that is below intrinsic value is you want to put in what we call a margin of safety, a protection that allows you to ensure that in case you had made errors in your calculations, in case you'd made errors in what perhaps you didn't consider, maybe changes in the marketplace, changes in the economy, or perhaps maybe unforeseen circumstances, that margin of safety ensures that you're protected. Now, let me take you back to what I started with today. I said that when you invest, there are 3 questions you want answered. The third of those questions was, can I reduce the possibility of loss? And can I maximize the certainty of gain? Now, the reason you're paying a price below intrinsic value is because if you pay a low enough price, that price will ensure that you never make a loss. Or even if there's a loss, it's so small. Here is the reason. I said that markets go through cycles. Let's assume you paid a price of £10 for this particular product, and the market goes down, and the product drops down to £8.50. Because you paid £6.25, you're still protected. You haven't made a loss. And there is still that gain of roughly £1.75 or something like that. So the key thing is that you want to have a price that ensures that you don't make a loss. But by paying at a low price, at the point of paying for the asset, you've made a gain. Now, I'm going to segue very briefly, and I'm going to bring this to a close. How many of you have heard the concept or have heard someone say, you make your money when you buy? Now, for so many years, when I started investing, I couldn't understand the concept. The people I learned from would say, you make your money when you buy. And I couldn't understand that because I was taught on the basis that you buy a product, you sell it for more than you paid for it, and then you make a profit. The reason I couldn't get it was because I hadn't fallen in love with the value investing philosophy. The reason why you make your money when you buy is because if you buy using fundamental processes of investing, value investing, you will be paying a price below intrinsic value. And therefore, at the point which you pay for the assets, you've already made a profit because you've paid way below its intrinsic value. And there's always a relationship between price and value. Price will always come down to meet value, or price will go up to meet value. It's a constant in life. The difference is how long it takes, and that is time. So as an investor, what you want to do is find an asset, pay a price below its intrinsic value, and wait. Now, I said you need the patience of Job. And you notice every good investor has patience, temperament. So you can buy an asset and you just wait because you know you've underpaid and the marketplace hasn't recognized that its true value is somewhere there, and you just wait. And over time, the price will move up quickly to meet value. Once it hits the value, you have that buffer. Now that buffer is called a margin of safety. So the concept of investing using the value principle comes down to two fundamental things you must always remember. You must be able to identify intrinsic value. That's the first thing. Secondly, you must be able to pay a price way below what its intrinsic value is. So you must always create a sufficient margin of safety. Many value investors will always say, depending on what you're buying, maybe buy at a discount of 30% or 50%. So effectively you're paying maybe 50 pence for £1 rather than paying £1.50 for £1. So it's all about identifying where you can maximize value. Now, that's all we're going to talk about in today's session. I hope it's been useful, but let me recap very quickly. If you're going to be an investor, you must understand the concept of what investing is all about. You must understand the definition. Once you understand the definition, and you've gone through the process of ensuring that you are investing and not speculating, you must then decide what type of investor you want to be. My preference is the value investment process because it's so simple and you're using fundamental analysis, meaning you need critical thinking, you need a level of emotional control, you need to do detailed analysis, then you need to identify a price that you're going to pay that is less than intrinsic value, where you have a margin of safety that ensures that the risk of loss is almost negligible and the possibility of gain is very high. That is value investing.